Hey folks, it's Jason here, and you know what? I want to let you in on a little secret. Most lenders don't even want to take the time to explain this to you because honestly, they're not really good at truly digging deep and doing the math and explain to you how to take advantage of refinancing your home. So right now, we're literally less than 24 hours of the jobs report coming out that's going to have a major impact on the Fed's decision on to whether or not they're going to cut the rates, right? Um, and that's going to have a direct impact on you guys. So I want to just teach you a quick little tool here. So that way, whether you use me or use someone else, you can do the math and it's a tool that you can keep with you for the rest of your life. Let's say you have a $500,000 loan and it's a $3,500 a month payment and your current rate is whatever it is, and you're getting ready to refinance, and you're going to have a lower rate that's going to save you, let's say, $250 a month. So you're already comfortable with the 3,500, right? So to go down to 3,250, that's huge. However, a lot of people might say, well, Jay, $250 isn't a big deal. Well, it is if you apply this really cool technique. So typically when you refinance, if it's done correctly, you can potentially skip up to 2 months worth of payments on your current loan when they close, right? So when they close, those 2 months that you don't have to make payments, that's your money, right? That's money that's not going out, it's staying in your bank account. So you can do whatever you want with it. However, I always encourage that those 2 payments that you don't have to make, keep them in the savings account. Also, when you refinance, they have to start your escrows all over again. So your current escrow account, the thing that holds the monies for your property taxes and your insurance, whatever's left in there gets refunded to you as well because they have to build a new one for the new loan. They can't just transfer it over. So that being the case, you could have, so think about it, almost 7,000 just in skip payments per this scenario. And then let's say you have another 1,500 in an escrow account, which is not uncommon. So now you've got up to 8,500 bucks, right? So 2 months go by, third month comes around, and it's time to make your new payment. Well, because you're already acclimated to the payment that you're making and you're good with it, you're going to make a normal $3,500 payment. So that right there, now you've got an extra 250 that's going just to principal. Then those 2 payments plus that escrow refund that I was talking about, that close to like 8,500 bucks, you're going to throw that right on top of the principal. Just doing that will take on average at least 4 years and some change off of your new loan. Yeah. So think about it. You're like, well, Jay, I've lived in my home almost a year. If I restart this, I'm going to start over at 30 years. If you do what I just said and stick to it, you will take 4 years off of your loan. You'll actually be in better shape on the refi than you were currently. You would pay the loan off in 26 years versus 29 years. Most lenders won't tell you that. Anyway, that's your tidbit for today. Thanks for watching. We'll talk again soon. Aloha.